Welcome back. My name is John Alpers. I'm a faculty member here at Tennessee Wesleyan. Today we're going to be talking about financial management. Specifically, we're going to give you an overview of managerial finance related to Chapter 3 in your book on financial management. Financial markets, when we talk about financial markets, they can mean a lot of different things. Financial markets are areas that people come together in order to do financial things. Whether it's borrow money, lend money, whether it's to acquire things, all the financial market, the definition is the ability to be able to move things. You could say commerce, but it's more than just that. It's anything. Anything that can bring people together. Okay, primary role is to facilitate the flow of funds. So what we want to do is take it from the people that have the funds, okay, that they're giving to us to invest, and to be able to invest those and use them in order to profit from them. Okay, the flow of funds come typically they're in firms and in individuals. There is a flow of how people make and use money. So younger people borrow, older people save, and retired people use their savings. What we're finding in the United States right now is young people borrow, older people are borrowing, and the savings is going down. Current times are that interest rates are very, very low. So there's not a real big incentive for people to save. And what's happening is when people are getting up here to the using of the savings, they don't have the same level of savings that they had before. It's causing people to rethink the way they're doing things, and a lot of pension funds and a lot of retirement plans and a lot of 401k plans are coming into effect because of these types of things. So individuals go through these, they call them life cycles, just like organizations go through, just like individuals do. So organizations can have it where they're borrowing a lot of money to get the business going. Then they should be saving and growing the infrastructure of the organization, and then they actually will mature their organization and use some of the savings that they've got. Now, the way that things are transferred from the savers to the borrowers is they use intermediaries. Intermediaries, one of the terms used is banks. Banks take your money, and banks don't just hold them and say, well, we have it for you later. They're investing the money into different things. We could do things directly, but most of us use some type of intermediary. Okay? The flow looks a lot like this, where these are the people that are needing the money. These are the people that have the money. Very rare that you write a check to an organization and say, here, I'm going to invest with you. Let me know how my investment goes. Most of the time it's going through somebody, either an investment banker or some type of intermediary to do this. Okay? Market efficiency has to do with the fact that people will put their money in places where they're going to make the highest return. We are going to allocate funds to their optimal use at the lowest cost. So being able to effectively and efficiently move the money to where it needs to be is what we hope the market is able to do. Information efficiency is, it should follow, and the operative word is should, it should follow that if I have good information about an organization, that good information should want you, the investor, to pay more for that organization. And information should be efficient and effective so that if I know that I've got a new product that's coming out, everybody should be able to find out about this at the same time. Because if one person finds out about this and buys a whole bunch of the stock, that's what they refer to as insider trading, because they had information that was inside of the organization that the rest of us didn't know. And there's been some very public cases that have been on this. But market information efficiency should be given out at the same time to everybody. And what we expect is that people are going to act the same way. So if it's good news, stocks should go up. Now, the problem with that is, do people always act the same way to the same information? They don't. They don't. So this is somewhat relative, and we talk about different forms, we talk about different ways that this works, but it should work that if the good information goes out, you would expect that the price would go up. Okay. The types of markets that are used are what you see here: monies versus capital, debt versus equity, primary versus secondary, and derivatives. We'll spend a little time on derivatives a little bit later on in this chapter, but derivatives are very interesting. I did those at a place I worked at a long time ago. It basically has to do with future contracts, guessing, speculating, potentially speculating what something is going to be 6 months, what the price of something is going to be. You can do derivative markets on grains, commodities, wheat, corn, things like that. You can also do them on what you think the exchange rate is going to be for certain currencies. That kind of stuff you can, I've seen people make a lot of money on that. I've seen people lose a lot of money on it. But derivatives are something that you have to know from a financial market what you're doing. Okay, general stock market transactions. The majority of us investors, be it organizations or be it individuals, deal here. We deal in the secondary market, which means the organizations will go in and do an IPO, an initial public offering, and say, we're going to offer you the ability to buy my debt or to buy my stock for a particular price. That would be the initial IPO market. Then the secondary market is, or the primary market is the people that they sell the IPO to. The individual investment banks and their big investors that they sell them to. Well, the first thing the investment banks and all of them want to do is they want to turn around and sell that to people so that they can make a profit off of what the initial IPO was. In this case, the secondary market is us. The primary market are the investment bankers that are dealing with the people that are setting up the IPOs. So it's very rare that IPOs are done by individuals, or even most organizations don't deal in IPOs. It's usually investment banks. So there's physical stock markets, being the New York Stock Exchange, American Exchange, and there's NASDAQ. There's mercantile exchanges that are regional. Because some of them, depending on whether you're in the South or whether you're in the Midwest or in the North, you'll have different mercantile markets that corn is going to be worth more in certain areas because it's more prevalent. In the Midwest, there's a lot of places that make a lot of corn. So the value of the corn to the people in the Midwest is going to be a little bit different to other areas. Okay? To have a stock listed, you have to apply. You have to pay a small fee, and you have to meet the exchange minimum requirements. I worked for a place once that the minimum requirement was that the value of the stock had to be a penny. It wasn't a penny. So they had to scurry to try and see why the stock wasn't trading at a penny, which was very embarrassing for the organization. The CFO was not very happy that his stock was trading that low, but they have to meet minimum requirements. Listings, a lot of times they'll do round lots, which means you can buy things in larger quantities. Okay, but there's some of the listing requirements for NASDAQ. Over-the-counter and NASDAQ things, those are a network of brokers, and they're a little bit more, lot more electronic, although everything nowadays is very electronic. People don't yell and scream and do that. There's a little bit of it, but all the days of the trading on the floor where people are screaming at each other, a lot of that has gone away. It's a lot more organized, a lot more electronic, a lot more systematized. So the SEC, the one who is in charge of all of the information, especially on the New York Stock Exchange, they are the ones that have jurisdiction over all of this. They've got to make sure the financial statements are right, that they're accurate, that they're timely, all of these things. They control the prices. The SEC can shut down the exchanges if they think things are getting out of control. They have a lot of control. Some people might argue too much. It depends. There are certain things that they have to do, that we need them to do. And there are certain things that they've, like when Sarbanes-Oxley first came out, the SOX Act, they went way to one side as far as really clamping down controls, to the point that what it was doing was it was causing a lot of organizations to go overseas. They weren't going to deal with the SEC because of the costs that were associated with it. It's not that the controls were bad, it was an added cost that they didn't have to pay for. They went to foreign markets and got their capital. Well, we don't want to see all of our capital going into foreign markets. We would like to see the capital staying in the United States. So the SEC had to kind of back down a little bit on some of their requirements. So you can see how things can get a little bit too much or not enough. You have to find a happy medium between a lot of these things. Investment bankers, they're the ones who sell the securities to the investors. They package the deal, and actually set the price of what your stock or your bonds are going to be. So raising capital, one of the most important things on anything that I've ever dealt with from a personal or from a corporation standpoint is the first question you need to ask when you're going to ask people for money. And you're going to say, hey bank, I need this. Or hey investment community, I'm going to do a bond issuance of a certain dollar amount. What you want to do is figure out the dollars to be raised. Spend a fair amount of time on how much to be raised, because what you don't want to do is a month or two later go back and ask somebody or ask a bank or ask anybody for money again. Make sure you do the analysis to find out. Only ask once. Ask for the money that you need and ask once. Now the type of securities could be bonds, could be debts, could be equity, could be preferred stock, common stock, different types of things. Knowing what that is. Whether or not it's a competitive bid versus negotiated deal. A lot of times you don't know what your price is going to be, and you don't know how much you're going to get for your debt until you put it out. It's a competitive bid. Negotiated deal is when you go, I'm going to put it out at this price. I'm not going to change this price. People buy it, and then if they market and trade and it goes up, then they'll make the money off of that. Competitive bid is a lot riskier than negotiated deal. Selection of investment banker is critical. You want to make sure that you've got somebody who has done your business before, not only done deals before, done raised capital, but has dealt with your specific industry, because your industry is unique to you. And you've got to make sure that they understand what they're doing there. Okay, second stage, what are the initial decisions? Make sure that the underwriting agreement is set. Figure out the flotation costs. Flotation costs, depending on the instrument that's being used, can be anywhere from 20–30% of the issuance. So if you're doing $20 million issuance and it's 20–30% of that, it's a big dollar amount. So you got to be very careful with this. Flotation costs include anything that it costs in order to be able to put out the security, which means lawyer costs, accountant costs, auditing costs, printing costs. Printing costs were a lot more. I was surprised how much they were in the ones that I dealt with. All of those things enter in to what a flotation cost is. And then you set the price. What is the price that I'm going to offer this instrument at? Setting the price it's not a science, it's an art. You need to be able to take in a lot of different factors in order to be able to get this. Okay? The investment practice itself, the amount of the issue should be the proceeds. There's our flotation costs. So if somebody needed that much, the flotation costs at 6%, that's pretty good. If 500,000 were issued, see how those costs can add up really, really quickly and can get rather large. So selling procedures, a lot of times there's syndicates, and what they'll do is the actual people that are putting on, the organization, will go on what's called road shows, where they'll take upper management and they'll actually go out and say, the reason you need to invest in me is because I'm doing this, 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 this. I'm a good investment because of this, and you should give the money to my organization. All of these things talk about underwriting syndicate is, firms spread the risk. If one place isn't going to do all of your debt at one time, you're going to spread it over different organizations. The leader or managing underwriter, that's the main underwriter that's in charge of your presentment. Okay, and there's usually a group of brokerage group that will allow, for distributing the new information. They're the ones that are going to set up the road show where you go out and try and say, investment community, invest in me because of this, because of what I'm doing, and all of these support that, but a lot of times they'll get spread out into different groups, so not one person has all of the risk or liability. Shelf registrations they were a big deal. They stopped for a while, and now they're starting to come back a little bit, because what it means is that, remember before I said that when you're going to get debt, make sure that you only ask once. You don't want to ask multiple times for debt. So if I ask for $1 million, but I really only need about $750, what I've got is on the shelf, I've got $250 on the shelf. That means if I'm doing some more capital things, I can actually come in and say, oh, I've got $250 back here that I've already got approved and ready to go. All I've got to do is put them out to market. Put them out to market. Held on the shelf until later date is, people are now, you don't want to ask multiple times, so they're asking for a little bit more and not actually using the security until they actually need it. Okay? Maintenance of the secondary market. Now, what happens with this, when the market goes out, you have your primary market, and you set the price. And then the market starts to move, and what you'll notice is that the price of your security either starts to go down or it'll start to go up. What they call this is the maintenance of the secondary market, because what you don't want to see is if somebody invested in you and you talked them in to investing at a certain price, and then all of a sudden they bought it at $35 and it starts to go to $32, $30, $25. They're losing money on your investment. What you would like to see ideally is you would like to see when the company does any type of thing, going public, giving out debt or whatever it is you would like to see the price start at 35 and then right afterwards it goes up a little bit, 36, 37. Now what that means is technically you could have sold it for more than the 35 you got, but it's okay, because what you're trying to do is you're trying to say, okay, I told you that if you invested in me that you would make money off of this. For it to be, for a couple days after an IPO went out, to go from 35 to 36, it's a good thing for everybody. It means that a lot of people like your organization are willing to invest in it, and the investors have already made money. You made the money that you thought you were going to make, so you're happy you got the capital, and everybody's happy. Again, it goes down to 34 from that 35. Now you've got people who are upset. Okay? Types of intermediaries are here. All different kinds of things will do different types of functions for you. Now, what we're finding a lot is that these here, the whole life insurance, mutual funds, life insurance companies, and pension funds are the ones that are contributing the most as far as investing in different organizations. Now, they have different requirements than some of the other groups. They have different requirements than actual organizations, because mutual funds, insurance companies, and pension funds are rated on how they do every quarter. So a lot of times they want returns to come in every quarter, and they want to show profitability, and they have to show results every quarter. So what has happened a lot of times is the change is that people are becoming very short-term focused. Short-term focused isn't always a good thing. You want people, I mentioned before, you want people to invest in things like fixed assets. Well, what that does is that takes money out of the short term and spreads and makes it so that I'll be better off in the long term. These people don't like that. And if you get these types of investors pulling out of your investment, that can make your stock can go down. So it's quite the management struggle to make sure that you get the information that you need, that you give them the information that they need, and that they don't start pulling out because you don't give them a return all the time. One of the rules that almost all of these groups have is that they want every organization to produce a dividend. Well, there's times in organizations you really shouldn't be giving out a dividend, because you've got investment opportunities that are going to reap big benefits for you, could be a year down the road. Well, if you do that, but you don't give out a dividend, all of these places cannot invest in you. So you've taken the number of people that can invest in you and you've shrunk it. By definition, you're going to reduce the price of your stock. So then what organizations do is they go, well, I've got to have a dividend of some sort, or these places won't invest in me, even though I'm a good investment, and everybody knows it. So what they do is they take money that they could have used in order to do research and development, in order they do whatever, and they actually pay out a dividend so that they can increase the funds, increase the number of people that are investing in them, increase the demand. You increase demand, you increase price. So there's a lot of good and bad going on, I guess, in this. So the role of the intermediary is to facilitate the transfer of funds. And there's a lot of different ways to do it. The benefits are that they consolidate, and they can do it a lot bigger, a lot quicker, better, and faster than you and I could. If I had to try and invest in an individual organization, that's one of the main benefits of like a 401k, is a 401k takes and invests for you. Whereas if I had to do the investing, I'd have to do the research on these organizations to see whether or not it was a good deal, bad deal, whatever. Okay. They also provide other services, but international markets we're seeing are starting to become more and more of the U.S. market, which we would expect. We're becoming an international economy, which is good and bad. The good part of it is if I take the number of people that I'm dealing with and I go international, I'm now increasing the number of people that I can sell to. The bad part about it is there's a lot more complexity I've got to deal with. Now I've got to try and move money back and forth. It might not be the same currency. It might be there's a lot of different things that could occur. Okay? So, are things regulated the same way in other parts of the country or other parts of the world? Absolutely not. So, we've found that historically the U.S. Institutions have more limitations, more restrictions on them than a lot of other places. That's a good and a bad thing too. We talked before about the SOX Act. Well, we know that a lot of these other places don't have some of that security. Well, what that means is that there could be some questions related to their financial information. So when I'm looking to do business for somebody and I ask for their financial information, am I really getting the best information if they're not using the same rules that I'm using? Or they don't have to follow the same stringent rules that United States has to do. There's a lot of subjectivity related to this. Okay, legislation. Congress is trying to legislate so that everybody acts as moral and as ethical as possible, but does it always work? Absolutely not. We want things to be as streamlined and function so that business can go as quick as it needs to, as quick as it wants to, but does that always work? Not always. You're going to find out as you go through the rest of your course that business is a lot more than just looking at one organization. You have to see the relationships between a lot of the other organizations and the impacts that it has to some of the stuff that we looked at here. This is the end of Chapter 3.